Hey everyone, and welcome back to another video for today. So in today's video, let's touch on the current issue with the US bonds going up, why that happens, what the US needs to do for it to come back down. We're also going to touch a little bit on the home prices, housing supply as well, the recent pullback in Fico stock, and the recent announcement of Sam Altman's wedding. The recent announcement of Openai acquiring Jony company for $6.5 billion or so. But when you look at this, it truly looks like a wedding invitation or some kind of wedding announcement. So anyways, let's talk about all of that in this video. If you're new here, hit that subscribe button. We'd really appreciate that. We're on our way to reach 100,000 subscribers. So if you're new here, hit that red button. You can always unsubscribe later, but only after I confirm that I'm getting my silver plaque. Thank you very much. And if you want to support me even further, do check out the link down in the description and in the pinned comment with the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. All right, so I'll first start, I guess, with the most boring part here. So home prices grow at slowest pace in nearly 2 years. Home price growth continued to ease rather quickly per Redfin. Year-on-year change in median US home sale price fell to just positive 1.4% in April, the slowest since June 2023. The housing supply rises to a 5-year high. Total numbers of homes for sale rose in April to highest level since March 2020. New listings rose to highest level since July 2022, an 8.6% year-on-year gain. As for existing home sales, they did drop to a 6-month low. So Redfin has shown that sales of existing US homes fell in April to lowest level since October 2024. That's down 1.1% year-on-year. That was the first drop in 7 months. And here what we can see is Zillow. They reported the monthly home value drops in 27 out of the 50 states. I mean, this does not trend in the right direction unless of course you have a ton of money and, well, you want to buy a home. You don't really care about the high interest rates, mortgage rates, etc., etc. But if you're on the other side, well, this isn't great. Moving on to the US Treasury. So what is going on? The US Treasury yield have surged with the 30-year above 5% and the 10-year over 4.5%, marking their highest levels since 2023. This is a clear sign of market anxiety about US fiscal health and inflation. Higher yield, of course, mean increased borrowing costs for the government and consumers. This, of course, could increase the potential for more market volatility if confidence in US Treasuries continue to erode. Now, unlike typical crises, investors aren't flocking to US bonds for safety. There is a sell America trend. More on that in just a second. Now, you might have heard that the auction that happened today, the 20-year Treasury auction, was horrible. But actually, it wasn't that horrible. It was maybe not as good as expected. But this is a screenshot shared by Dylan on X. The May 20-year Treasury refunding auction was mixed, though leaned toward the weak side despite its 5% coupon. The auction tailed by 1.2 basis points, the largest at a refunding since November. Indirect bidder participation rose to 69% of public issuance versus 63% in February, and the last 3 refunding average of 67.8%. Direct bidders shied away versus their recent history, winning 14.1% of the sale versus 19.5% at the February refunding. Despite fluctuations in direct and indirect participation, primary dealer stake came in at 16.9%, the lowest at a refunding since August 2024. The $16 billion auction stopped at a yield of 5.047%, 1.2 basis points above the market's expectations of 5.035% at 1 p.m. New York time. Now, why is the spike happening and why is there weaker demand for US Treasuries? Well, the spike is happening because 1, there's growing concerns over the US government's rising deficit, especially after Moody's downgraded US debt and the President Trump's new tax cut proposals. We've talked about the Moody's impact in Sunday's video, but I do want to touch a little bit on that again. The recent treasury auctions have seen weak demand, forcing the government to offer a higher yield to attract buyers, because essentially what you're getting here is like me selling you a piece of paper. I'm telling you, look, you're getting 5%. And you're like, you know what? Yeah, 5% might seem good, usually, actually very good. But based on the data and the sentiment right now, we are actually, well, not that comfortable buying it at when just getting 5%. So we want a little bit more. And that's basically what we're getting right now. And it definitely did not help to get downgraded by Moody's on Friday. Although, as I've said previously, the other two rating agencies have already downgraded the US back in 2011 and back in 2023. So basically the US was already not a AAA country. The other two reasons are as follows. Persistent inflation and new tariffs have also unsettled markets, and investors, sometimes called bond vigilantes, are demanding higher returns to compensate for perceived risks. And it makes sense, right? It's the same with us retail investors or investors as a whole. If we want to buy a certain asset, we want the best risk to reward, right? If we are saying, okay, that asset is risky, but the reward is very, very good, then we are willing to pay a little bit more for that. But if that asset is risky and the reward is really not that great, why would I risk my money? Just doesn't make sense, right? Plus, also usually, when there is uncertainty, you would go and buy bonds because that's just safer. Now you might say, actually, right now, 5%, it's actually pretty good for me, no? It's actually pretty good for me, especially in these uncertain times. So on the one side, you will find people saying getting paid 5% is very good. And on the other side, you'll say, yeah, 5% is good, but I think we deserve a little bit more. And if you needed a small reminder, Moody's had a AAA rating until Friday. Then after Friday, it became AA1. The reasons, rising debt and, well, the deficit. Fitch had a AAA rating, went to AA plus back in 2023, and S&P Global had a AAA rating, but went to AA plus as well, but that was back in 2011. Now, here's a, I won't say prediction, but a worst case scenario is if, let's say, the S&P Global downgrades the US again now. That would cause a huge shock, I'd say, much bigger than the Moody's one. It is a possibility, but a small one. And if you want to know what each one means, AAA, AA1, AA+, here it is. Do pause the video. Now, what should or could the US do for rates to come down? Well, one, very simple, reduce government spending. I think we can all agree on that. Manage debt responsibly, basically come out and say, look, this is the plan going forward. And well, the market has to buy that plan, of course, in order for yields to come down. Shift to shorter term debt. Right now we're talking about 10, 20 year, 30 year ones. You can shift to shorter term debt and that will reduce the pressure on the longer term ones. It's an option. Promote non-inflationary growth. This is something that Scott Bessent has talked about, right? We are going to focus on making sure that revenue growth but accelerates in a non-inflationary way. If that can happen, that's already a very, very good step in the right direction. But I think step number one here, reducing government spending, should also be considered as extremely important. It's great if you can increase your revenues, but there will come a time where you will just have to deal with government spending. It cannot work like this forever. And then the last one, of course, well, the last two ones is one, the Fed could lower the federal funds rate and they could start with QE, quantitative easing. I guess that's the last resort here. Now I'll ask you, the viewer, what do you think will happen? What do you think should happen out of all of these options? Write it down in the comment section below. Moving on to Fico, Fair Isaac Corporation. It has seen its stock go down by over 22% in the most recent pullback, but as you will see, the stock has still performed quite well over the last couple of years. This is a company worth $49 billion. And as you can see right here, this is also a company, a stock that is extremely expensive. A trailing PE of 95 times, a forward one of 67.8 times. But this is, of course, also a very, very strong company, a very strong business gross margin of 80.8%, EBITDA of 44.9%, net 31.4%, and free cash flow margin of 38.2%. A very, very good company, very good business, very profitable. If we look at the growth rates, the expected growth rate 2 years out, revenue growth 15.6%, EPS 23.7%. So of course, people are willing to pay a premium to buy Fico. But how much of a premium are you willing to pay? Now, the recent pullback, is this an opportunity? Maybe yes, maybe no. Let's first maybe look at why the stock has pulled back. Now, with the power of AI, we get that answer pretty quickly. So the primary catalyst for this sell-off was critical remarks from the director of the Federal Housing Finance Agency, who questioned Fico's pricing strategies and advocates for more affordable credit assessment options. Specifically, the FHFA director called for Fico to offer more economical solutions and suggested the potential privatization of Fannie Mae and Freddie Mac, which heightened concern about increased regulatory scrutiny and competition in the credit scoring market. These comments triggered immediate investor concern about Fico's future pricing power and its dominant position in the mortgage and credit scoring industry. As a result, the stock fell 8% on Tuesday and a further 11% in early trading on Wednesday, marking one of the steepest declines in S&P 500 during this period. And on Wednesday, it's actually closed down 15.7%. Now, to me, these comments basically mean that, well, Fico is a very strong business and has insane pricing power. A little more on the Fico business. They generate revenue through two segments here: total on-premise software revenue and total scores revenue. As you can see, total scores revenue have increased faster than total on-premise software revenue. And since, well, in the last, let's call it 4 years, total on-premise software revenue has increased at a compound annual growth rate of 10%, whereas total scores revenue has increased that by 15.2%. Now, I do want to point out that total annual recurring revenue, the year-over-year growth rates have come down since the September quarter of 2023. Back then, we were at 21.7%. We're now all the way down here to 2.5%. Of course, you might say this might be the bottom because, as we've seen previously, we've seen it extremely low and then go up. And then, well, since that peak, we've come down. So maybe we're going to see a bottom pretty soon. Although what you can see here is that total annual recurring revenue did come down quarter over quarter. Another not so great metric is total dollar-based net retention rate that has also peaked back in September 2023 at 120%. Now we're at 102%, and that came down quarter after quarter after quarter. And here again, maybe this is the bottom. If we look back 4 years ago, we were at 99%. And since then, well, that number actually went up and up and up. So this is again something that you have to keep an eye on. Now, all in all, what does the market expect Fico to do? We've seen what they expect revenue to do, but what about free cash flow? Free cash flow in 2025, or fiscal 25, is expected to grow by 16.6%, then 33.8%, and then another 29.4% year-over-year growth in fiscal 2027. If we look at the business, we zoom out, we look at gross profit margin and free cash flow margin over the past 10 years. As you can clearly see, gross profit margin has increased from 67.7% to now 80.8%, whereas free cash flow margin went from 14.5% to 38.2%. I mean, this is basically why you are paying a huge premium for the company. Now, going forward, remains to be seen what happens, but one cannot deny that this is not a high quality business. Moving on to the Sam Altman and Jony Ive acquisition merger of I.O. This, again, every time I look at this, this is the strangest, cringiest thing I think I've seen in a long, long time. For those that don't know, Jony Ive used to work at Apple. He was one of the designer brains behind the iMac, the iPod, the iPhone. So yeah, everything that you're seeing right now hyping up this guy is because of his work back at Apple. Afterwards, through another company, he did work with Ferrari and Airbnb, mostly, of course, on design stuff. So, okay, maybe a couple of months from now, a year from now, I think the products will come out, the first product in 2026. Maybe MKBHD will make such a video on his channel a year from now, remains to be seen. But let's talk a little bit about the announcement. So this is basically what they're saying. Again, it really looks like some kind of wedding invitation or whatnot. This is an extraordinary moment. Computers are now seeing, thinking, and understanding. Despite this unprecedented capability, our experience remains shaped by traditional products and interfaces. 2 years ago, Jony Ive and the creative collective Love From quietly began collaborating with Sam Altman and the team at Openai. A collaboration built upon friendship, curiosity, and shared value quickly grew in ambition. Tentative ideas and extrapolation evolved into tangible designs. The ideas seemed important and useful. They were optimistic and hopeful. They were inspiring. They made everyone smile, etc., etc. This is really, really long and boring. Basically, as I/O merges with OpenAI, Jony and Love From will assume deep design and creative responsibilities across OpenAI and I/O. We're going to hear probably more from them later this year, maybe some previews, but the first product I do believe I read is coming out in 2026. And of course, this is another move by OpenAI to make sure that they differentiate themselves from all the other, let's call it LLMs, because I'm pretty sure that he knows that OpenAI is nowhere near close to being valued at $350 billion, right? Okay, the market, the private market might think it is, but if we're being realistic here, I don't think that makes any sense. So he's taking that opportunity, that huge premium valuation that OpenAI gets, and he acquires companies left, right, and center to make sure that they actually have a differentiated solution. Now here, mixing software with hardware is of course a very strategic move. This is something that Meta is doing, this is something that Google is doing, and this is something that Apple should have been doing. And of course, Jony Ive coming from Apple, this is maybe a hit to Apple as well. Now, will this work out? Remains to be seen. I like hardware tech, and especially where we're going from now, AR, VR, you name it, AI-enabled hardware, pretty exciting stuff. But just because everybody's hyping up Jony Ive because he came from Apple, because he did something 10, 15 years ago, does not mean that it's going to be 100% successful right now, just so we're clear. So that's about it. That's everything you needed to know of what has happened today. If you enjoy this type of videos, hit all the buttons, and I'll see you all in the next one. Bye-bye.